If your retirement account isn't where you want it to be, you might be making a couple simple mistakes. LeVitre is a certified financial planner and author of 20 retirement decisions you need to make right now. Ray, the stock market's had the last couple of years have been actually pretty good. So why do people feel like they're not having a good investment?
Well, it's unfortunate because a lot of investors just aren't doing very well, and studies show that most investors don't do very well. In fact, I cite a study in the book that shows the last 20 years that stock mutual funds averaged about 8% a year, but the average investor buying those stock mutual funds averaged only about 3% a year. So while investments were doing well, the investors who were buying those investments were actually doing very poorly.
That doesn't make any sense at all. So why do investors do so poorly then?
It's really crazy. I mean, it's what you would think that we should buy low and sell high, but the average investor does exactly the opposite. They buy when they feel good, which is once all the investments are up, and they sell when they feel bad, and that's when the investments are down. And they do exactly the opposite of what they should do.
So when we're looking at their investments, what is the actual investor looking? They go back and find some stock that did well in the past? Is that sort of what it is?
Yeah, in fact, you can think about it with your 401k plan. You have your 10 or 20 options, and you look down and say, what was the performance in the last year? You tend not to buy the ones that were down 10%. You tend to buy the ones that were up 20 or 25% because you say, I want that 25%. It makes me feel good. I'll jump in, and I just bought high.
And that's the whole problem when we're emotionally investing. The things we think are going to be good, and they end up not being good. So what should we do instead?
Yeah, the best thing to do is simply to diversify your investments, put money in different segments of the stock and bond market, and then stick it out.
You like to liken this to like a baseball field, right?
Exactly. Yeah, in fact, if you think about a baseball field and a coach spreads their players across the field because they don't know where the ball is going to be hit. And investing is the same way. We should spread our investments across the stock and bond markets because we don't know what the market's going to hit. But if we have coverage over the entire market, something in our portfolio will likely do very well.
How many, because there are several positions on that baseball field there, how many should we realistically be looking at?
Yeah, good question. Typically, your portfolio should have anywhere from 8 to 12 different investments, and each of those investments should be they should be invested in a different component of the stock and bond market. So examples would be that you should have large company stocks, mid-size, small-size, and international stocks in your portfolio, as well as a distinction between growth stocks and value stocks, and then on the bond side, government, corporate, and international bonds. And if you have all of those things in your portfolio, then even in a 2008 where the market was down almost 40% or large companies were down 40%, government bonds made 22%. So if I had that piece in my portfolio, my overall portfolio didn't drop as much, I was less likely to overreact, and consequently, I probably experienced better returns.
I sort of have a mutual fund. I get my automatic, withdrawal kind of stuff put in there. Right. And I assume that that's diversified because whoever's managing that is diversified. But that's not necessarily the case then, right?
Yeah, that's a good point. Your mutual fund in and of itself might own 50 to 100 stocks, but there are 50 to 100 stocks in just one piece of the stock market. So you need one of those for each different piece of the stock market. And again, also the bond market.
It's all that diversification thing you're talking about, and
exactly.
Not being emotional and stuff. Exactly. Ray actually would like to answer more of your financial questions, and he can actually help you with that diversification too. He's doing a great giveaway right now. He's written the book on how to retire. 20 retirement decisions you need to make right now. And the book he wants to give to you, all you have to do is go to his website, go to the website networthadvice.com, click on the button that says Contact Us. The first 50 people to request a book will get a free copy. And of course, we'll have more information on our website as well on how you can find out about diversification and not emotionally investing. Thanks so much for stopping in, Ray.
Thank you, Dan.
Okay, coming up next, what do you have to do when you have to when you get that tough call from a teacher indicating your child has trouble paying attention at school? How to react, reason, and respond, and get to the bottom of what's best for your child. Therapist Julie Hanks weighs in on the emotional side of that family challenge next on Studio 5.